This is Money Bites. I'm Michael Vincent, and today's topic, fixed interest rates. A fixed interest rate loan or a fixed interest rate mortgage is a loan or a mortgage where you fix that interest rate in for a period of time. That can be 6 months, 1 year, 2, 3, 4, or 5 years. Why would I fix the interest rate in for that period of time? Well, generally speaking, you're going to get a lower interest cost than if you had it on a floating loan, but you're going to lose the ability to pay it off early. Why would I do that? Well, fixed interest rate loans are really good for reducing the interest costs. They're good for budgeting. You know how much you need to pay, when you need to pay it, and it's not going to change for that period of time. So you're going to have regular repayments that will be either weekly, fortnightly, or monthly, and those will be set at the start of the loan. So when you go to fix the interest rate, the minimum repayment might be $500 a month. At the start, you could set that to $550 a month, maybe $1,000 a month. You won't be able to change that until that fixed rate rolls off at the end of the term. Different banks have different nuances and sort of quirks to their fixed rate loans. So for some, you'll be able to pay maybe 5% more over that time. Some you might be able to reduce it and pull it back up a little bit, but it's really important to have a robust discussion with your bank about the fixed rate terms, just so you know exactly what you're signing up for. That was Money Bites. I'm Michael Vincent. Cheers.